Hi, everyone. I'm James Garbutt.
And I'm Denny Dumas.
And this is the Garbutt Dumas Real Estate Podcast. This episode is about getting your finances in order. And this is a short and sweet one. And the intent here is to highlight some tips that we want to just share for anyone thinking of buying or selling, or any homeowners right now that have a big mortgage. Denny and I have run into some stuff over this last year that I think it's just important to reiterate once or twice a year so people make less mistakes that we do. And what I'm getting at is just ways to save money that are easy. I mean, right now we're in this world of ridiculously low interest rates. So the thing that comes to mind, and I spoke with a friend of mine in the business, Alex McFadden, and before this podcast, I want to ask, what are some simple tips? And he says, in pretty much any cases, one of the odd things that they're running into right now is rates are so low that clients that bought in the spring of this year, like in March, and got a variable closed rate, are now converting those variable rates to fixed rates because they're, fixed or variable. So the variable differential, I mean, I don't know if you recall earlier this year, but you were getting 0.1 or 0.2 off prime, and now it's 0.6 or 0.7.
Yeah.
So changing your variable mortgage, even if you got that mortgage earlier this year, right now is a good time to talk to a mortgage specialist about, does it make sense to change your mortgage in any way? And that might be going from variable to better variable or variable to fixed. There may be a penalty. That penalty may be able to get incorporated into the new rate, and you still may be better off. Some quick rules of thumb: if you have a rate 2.59% or higher, Alex is saying that in pretty much every case, it makes sense to redo your mortgage today. And if you have a variable rate that is close to prime, it makes sense to talk to a mortgage specialist. So get your finance in order. These are big numbers if you have a $500,000 mortgage, and this adds up over time. I have been a seller this year, as long as Denny has as well, and we've incurred some lovely mortgage penalties. So for anyone stretching themselves, recognize anytime you get out of the A lender world to the B lender world, it comes with a lot of lending expenses, not just to get the loan, but also to get out of the loan if you're not getting out of it on the maturity date. Yeah. So Denny and I paid a hefty penalty this year when we sold our renovation project there at 405 2nd. I think it was north of $20,000. So some tips to reduce that penalty. One, hopefully you don't get there in the first place, but it's okay if you do. It's a small percentage of the value of a home. So if you get there, it's part of, you wouldn't get the home without the loan. But pay down the maximum that you're allowed to. So, one way to reduce a penalty is oftentimes a loan might allow you to pay down 15% a year in lump sum payments. Just getting that lump sum payment down from wherever you can, line of credits, wherever you have money, will reduce the penalty substantially. Even if you know that you want to sell next year, maybe if you have the means, do a lump sum payment this year, do a lump sum payment next year if the loan allows it, and your penalty will be much less. For a place, I think we've had penalties that range anywhere from $3,000. Well, I mean, penalties can be anything, but commonly $3,000 to north of to upwards of $30,000 is kind of the range, with most of them being in that $10,000 range, we'll call it. But it can be all over the place. But if you have a $500,000 balance and there's a $10,000 mortgage penalty, if you have access to $75,000 to pay down that balance a little bit, your mortgage penalty should go down, 20%, call it, or 15%. So pay down that mortgage to reduce the penalty. There's also a hack, and I'm not going to get into this. This is where you talk to a mortgage specialist about blend and extend. That's all I'm going to leave it at. What that means is you take your existing mortgage, you blend it with a new one, you extend it, and somehow there might be a way to get out of a penalty or reduce your penalty. I'm not going to elaborate on that any further. Talk to a mortgage specialist about it. Another thing, reduce your debts. So if you're buying next year, and I'm saying this because I've had a few conversations with people this year that are planning for next year. If you are buying up or just want to get in a buying position, recognize that banks want high income and low monthly obligations, payments, leases. So if you have any high interest loans, pay them off. Leases hurt you if you're trying to leverage, and just debt in general. You don't want to affect. The stress test is a thing, and income, it's dependent on high income. And that's where I'm going to kind of roll into the next thing, because business owners often, or a lot of people out there that have a business or some sort of separate entity that earns income, which is a business, they have the ability to manipulate their income. Now, it's common to try to live a very humble life and pay the least amount of taxes, but a bank needs 2-year track record of high income. So if you are planning on buying a piece of real estate or planning on taking advantage of leverage and bank cheap money, I'd say right now is a time to consider paying a lot of taxes, having a high income. Like, a typical, like maybe this is a more extreme example, but say if you're a fortunate, like a business owner that has the ability to claim $50,000 as the bare minimum of your living expenses, or claim $150,000 to plan to leverage up on a purchase over the next few years. If you pay that extra $100,000, if you claim that extra $100,000 in income over the next 2 years, you might have a tax bill of, let's call it 35% extra on that 100,000. So maybe you're paying an extra 35 grand this year and an extra 35,000 next year. So yes, 75,000 or 70,000 in extra taxes. But that extra $100,000 in income might get you an extra $500,000 in loans. And if you can use $500,000 loan and park that in Vancouver real estate, is 5 years from now, are you going to be better off having paid those high taxes, leveraged up with cheap bank money, got a property that's in a higher dollar value range than you could normally afford over a 5-year period versus saving those taxes and keeping the money in your business? And, it really comes down to, well, if you invest in something else, sure, yeah, you might be better off by keeping the money in your business. But if you are not investing in something else that's aggressively going up, I would say it's a good time to pay some taxes and leverage up. Because if you start doing it today, you might be in a great buying position in 2022, 2023. And that, to me, sounds like a good time to buy and take advantage of, hopefully, the ride of price increases that happen in the mid-2020s.
And
I went on a real long time. Denny's here too, guys.
With how much the governments have given out this year, the taxes in 2023 may be a lot more than they are today too.
It's true.
Maybe saving tax money.
True. I think a lot. I've just witnessed a few business owners that really struggle to pay taxes. And when you look at all I would say is look at a residential loan as a business and look at the purchase as a business and see if it makes sense. Because to me, taxes are they're never fun to pay, but it's part of life. But when it gets you more bank money, there's a very strategic reason to have that, to claim that higher income. And before you just say, oh, you know what, I listened to James Garbutt on the podcast, I got to claim the highest income possible, talk to a mortgage specialist, because some banks might take into account your corporate income without it being personal. And I don't understand how that world works. But from my understanding, claim a high income, don't hide the money in a corp. It gets you more money from a bank.
Start that process early too. If you're considering buying, let's say next year in 2021, connect with a mortgage person or your bank soon. Get that process underway and be ready to purchase. Banks and mortgage people right now are very, very busy, just like realtors and home inspectors are. And the turnaround time from personal experience in the last few weeks is much longer than you think it is going to be. So I would say get all your financial documents to your mortgage person, get set up and get ready to purchase, even if you're 3 to 6 months out. May save you a headache down the road.
Yeah, and that's key. Like next year, if you're thinking of doing it next year, start now.
Yeah.
Get the documents in now. Start watching now. It's always good to be early because you might be able to reduce your penalty or get more, a higher loan.
Yeah.
And when rates are under 2%, I would like to get as big of a loan as a bank would give me. Yeah. Anyway, this is coming from some personal pain of expenses we've had this year from Denny and I. So hopefully you get some value out of this. And our intent here is to save you money.